Let's start with you. You stand these volatile right now. This thing that you've heard talk about a lot in this ring, also lumpy events the past few days. How do you ensure the in sharing of prominent consistently delivered at the promises? So,
Yeah. Well, thanks so much for the sessions. I think existentialism has kind of been the theme of the last couple of days. And if anyone's going to pen and me talk about it, I have gone out and basically asked for hook. But I think what we are learning is that the early buyers seeded the market in ways that actually made sense, right? So we wanted projects to go from lab to field. And the big responsibility that we as a community now have is how we get projects from field to 10x. And that's where I think the early market signals actually helped quite a bit. So we had offtakes of the signs that are yet to be delivered. And a big part of my focus now is to make sure that these offtakes deliver on time. So how do we do that? Offtakes, can be a good, I suppose, tool to cash out revenues that are stuck in future, that are pay on delivery, and there are creative ways in which we can actually unlock the capital that is stuck in future today. A big part of my job is to work with banks who sit at the back of our platform, and then apply creative structuring together with insurers to make sure that if there is capital to be had to execute these projects, then we can actually do that. There are three ways in which we can do that. Working with you guys, if you've got assets that even pledge, then we can creatively back that with the offtakes and structure a debt instrument off the back of that. If you don't have fine, we can work with insurers, and I see another insurance friend of mine in the audience to basically help you unlock working capital. But that's kind of the space that I'm seeing out in the market right now. If you're a project developer sat in the audience and you're wondering what is it that I care about, and how do I actually sustain my business until the compliance markets kick in, or what the other buyers that we're waiting for step into the market, then think about the time frame on which you actually want to execute the projects. Think about the amount of cash you actually need, and think about the flexibility that you're wanting until the science is proved out. And with those three factors, we are actually able to do more on the financing side, getting banks involved, getting them to understand the risk, and actually fill in that capital gap that exists right now. And that's the hopeful message that I'll kind of punt out over here and say that it's counter to the untouchables that might actually exist.
It'd be great to hear the project developer perspective. So, Diane and Louis, you both lead major operations in Brazil and Bolivia. And the narrative often is that the global south is considered cheaper due to rebrand labs. But then when you factor in interest rates, local financing hurdles, does that advantage actually net out, or is it there? And how does that tie back to that? Then, sir.
Sure. Thank you very much. So operationally, it is cheaper. So you were mentioning labor cost, also land. I would like to add other elements such as feedstock availability, then things such as energy abundance, energy prices. So, for instance, the Bolivia grid where we operate has similar emission intensity to OECD countries, but it's 5 times cheaper. So there is an operational element to this. However, as you mentioned, when you get into the financing costs, that's where you hit the wall. So, quick facts. The sovereign credit premium risk. Bolivia is between 500 and 600 basis points. So that is 5 to 6% interest that you are already down if you want to do a similar project in a OECD country. So you would say, okay, why don't you go to local financing instead of looking for international finance? So local banks in Bolivia, for the best credit ratings of corporations, to charge somewhere closer to 11 to 12% of interest rates. So that is very high. But not only is about the interest rate, it is also about the tenures of the loans. So typically you would get a loan 11 to 12% interest rates or 5 to 7 years repayment time. That is too short. Our capex and our financial projections really depend on longer term payment plans, and you just simply do not get those in the national environment. So you do need to get a solution of blended finance. International commercial banks with, in the case of Bolivia and the global south in general, international development finance. And this is exactly what the international development finance was meant to do, help reduce the country premium and access to market limitations. So with blended finance, we are able to get lower rates and longer tenures. And this is exactly what can unlock the kind of scale of project that we're looking for, because local interest rates or the international rates without the development finance would just be too expensive.
Yeah, very interesting perspective. And I'm just thinking in Bolivia, quite expensive if it comes to capital. Like in Brazil, it's even more expensive. When I got aware and we were starting to model out also future costs, especially on a unit economic basis, you have to assume that everything which is in Brazil at the moment, if it comes to interest rates, will be above 15%. So if you take your money, you put it in your bank account, you get 15% without any risk. Any bank, any institution in between, which is providing at the end the financing, will need additional capital. So you end up in financing scenarios where you have to pay 20 to 25% interest, which sounds shocking. Of course, there's capital outside which you can allocate, but I think the question, especially as a carbon removal project developer, is which problem you tackle first. And getting capital outside from Brazil is also not so easy, because you have all those country risks, you have the language barrier, especially in Brazil. So we took a little different approach on looking at this problem. How long do you need at the end of that? And we as a company, we are doing carbon removal with enhanced rock weathering, which is significantly faster in Brazil. So we're talking about 10 times faster. You go to Europe and you apply the rock on the farmland, you might end in 5 to 7 years to get your full carbon removal potential. And you have a time of 5 to 7 years until you'll be able to pay back a debt, which is maybe an interest rate of 5 to 7 to 8%. In Brazil, we are able to do this with less than half the time. So the time we need until to get the cash returned is significantly faster. And this is where we are at the moment optimizing a lot. Forget the time from the investment of the money until the return as fast as possible. And there Brazil, with the very high temperatures, with very mineral depleted soils, that just significantly help us. Plus, we're also doing a lot of science to get this initial process even faster. And so I think this is this is kind of the perspective we take. And in addition, what we're at the moment exploring, especially if the offtakes and like the volumes getting larger, that there's a lot of international interest to use capital and also to bring it to breach. So, but I think like from a project developer perspective, looking at like 3 to 5 to 10 years, trying to solve the problem, which is the limiting factor for the company, and if it's cash, I think trying to find a solution which is also in line, which was already available, instead of kind of building new mechanisms is very important.
Okay. So earlier you mentioned kind of this package technologies applying to get from lab to field and field to scale. So now how are country to getting to the scale? Can you give us a little bit insight into the capital stack and how do you think about matching the right capital to kind of other?
Yeah, I think it's such a good question, and I think I'll build on Daniel, your point, Felix, your point as well. In terms of identifying your needs as a project developer, looking at the sort of difference between where you access the capital versus where you're building the project itself is super important for you to then sort of figure out what geographies of capital can I actually pull from. Do I, for example, get a loan for Europe, or do I actually get a loan from Brazil? Do I lean on philanthropy? Do I lean on, LTPs? And I think that then kind of goes into the equation of how long do I have to spend to then get the capital as well. And all of these different factors kind of add up to thinking about who do I approach first. Philanthropy serves a very interesting anchor point as it relates to providing concessionary loans, which I've seen happen really well, but it takes a long time. You've got the second sort of stack, which is venture and sort of venture debt, which is a cross between equity as well as debt, and especially at the higher risk stages of technology deployment. You've got that ultimate credit finance and infrastructure finance dream that people are looking at, and in between there is lots of post-career opportunities that I think we're working on, which uses a little bit of offtake-backed working capital style loans or offtake-backed project finance style loans. But that's kind of the broad way that I like to think about the capital stack. I would love to see more creative financing kind of come into that space. But ultimately, it's about speed, it's about access, and it's about pricing. The way I think about it.
Sir, I knew I was next.
Wait, so to tie back a little bit to what Felix and Daniel were talking about, the challenges in Brazil and in Bolivia, I want to hear from your perspective at Wild Assets, where my understanding is you national capital as an institutional asset, and how do you think about bridging the gap between risky emergent market projects and the more rigid requirements that a sort of asset manager?
Yeah, so I appreciate the question, and I think that there's a couple of pieces that I'll try to anchor on that make this relevant and worthwhile for people who emerge as probably early buyers that aren't one of the Fortune 500 companies that are traded on an open marketplace. I think for demystifying some of that capital stack of how what assets chooses to operate is that we like to see early stage companies that are either getting ready to list on one of the registries. So we don't want to do someone else's jobs, right? Rainbow, Isometric, Puro have created an enormous amount of use case and helpful kind of that launch pad for where Catalytic Climates gets to come in and support a project. So as an asset manager, that's not really something that we're looking to take the place of. But we do like to see that's part of the milestone development for a project. So when I would say typically it takes us anywhere from 3 to 6 weeks to make a decision on whether or not we are going to invest in a long-term opportunity of a carbon renewal offtake. We don't do upfront purchases, so we are available to you when the carbon product is ready, and then operate through for a contract anywhere from 5, 7 to 10 years. The pieces that we will shop around and figure out is okay, well, what does that TRL level look like? When are they getting ready to enter into the market? And then certainly for us, some of our pieces that we are watchful of is what is the political climate in which you might be entering into that market, and how do we de-risk for that? So by holding that asset a little bit, of course, with 10-year longevity, with different milestone tranches, whether or not it's listing first with a methodology on a regulated registry space, or looking at a project that's well established but needs additional maybe venture debt or something like Sumitomo's when you come in and say, hey, we need to see demonstrated that you have more offtakes other than just like a Microsoft or a Frontier. And we have the past year been rewarded with this idea that that type of catalytic finance can be, structure the offtake, do a capital formation behind it through like a series of family offices or LPs that see value in this commodity structure, maybe not so much as a climate play, but as something that they want carbon exposure to in their portfolios, and then looking for what their exit strategies might be along the pathway for that at that contract. And whether it's a baby company that hasn't listed their methodology on Puro or Isometric, it's not necessarily, it doesn't matter to us. We just need to see that that longevity and intent is there, and our contracts reference that. I don't know if anybody remembers the Oscar piece that went out recently as a contract to like demystify the contract language, but that was ours. We worked with Pete to make sure that this was something that was available for people to look at, because I deal with a lot of suppliers and Matangas too that just haven't really had to negotiate well for their price. or have to contend with, okay, well, if there is capital taking an early risk on you, it's still this idea that we don't know if you'll deliver. And we also maybe don't want to take that risk. And certainly it's not just we, but it's our group of LPs that aren't necessarily as responsive to the moment of climate and morality as you think they should be, but are absolutely commodity brokers. They look at zinc, copper, and gold as those like attribute pieces, but see the emerging carbon market removal space as they did when cryptocurrency was coming live at vogue, and they're looking to purchase parcels in the Indian space. That this isn't so dissimilar, and there aren't many nascent new commodity structures that are emerging that aren't going to be regulated in the same way. So you have this beautiful point for the next like 5-10 years where suppliers hopefully are able to negotiate for a good price without knowing what world conditions are going to be like in 10 years, but can get some of the benefit back from a spot trade once it comes back in the market, especially if suddenly corporates want a lot, but there's not a lot to get. So working with suppliers, making sure there's a price ceiling that's a benefit to them where we all take in the profits for what that means. That's a little bit more of that community build that I think is more climate focused that we offer in our contracts. So it's not like just a cutthroat commodity play, but that's a way of building more catalytic cases in the market. And I know I offered first that we don't do any upfront purchase payments, but we work with people that do. But we have a few projects together with TerraSet and Baccarat family offices to provide that upfront capital that will turn into a long tail wild assets contract where they might just do a spot purchase at whatever price you choose, and that there'll be something that's a little bit more elegant over that longevity of the contract. We look for things like that to be able to work together. And obviously the big whale to land is always which bank can you identify to work with you through that letter of credit or bankability point. And we're increasingly starting to land on valuable players that are looking at that bankability piece, but certainly more mature and project developers and suppliers.
Lot of we ask a follow-up question. And here, I only learned in the conversation for a little bit about what you're doing at TSC was super interesting and highly relevant, especially in the time you are. And I'm a bit curious about like the project sizes you're targeting at the moment. What's the sweet spot you're looking for?
So I always tease like we hate DAC, but that's not true. We have like DAC. We're a little bit just like our LP hate DAC because there's not a good arbitrage or price spread that we can get across that. But like sweet spot, we don't really discriminate on how much is available. One of our baby projects has like 1,000 tons that they might bake 1 year. But over the contract duration, they'll do anywhere from like 24,000 to 50,000 that we have, right of first refusal, all the stuff you usually see in a contract. And then one of our landmark projects that I know that we're really proud of is Frontier Carbon Solutions, now Frontier Infrastructure. But BEX is really a lovely space to be operating in because of that price potential that suppliers can get a good price for their concept, and then that bankability and rate of return is actually quite, it's good for the arbitrage. It isn't stable yet, but it's predictable. Was that helpful? Yeah, sorry. It ranges, and we're always open for discussion and negotiation, but the baby contract that I mentioned, they use that to get additional topco equity. Like they got more money from their investors because they got a price signal and a commercialization interest. And that's kind of what our original aha moment when we were talking about how do we make something that's a financial instrument that fits for suppliers. No one cares about the supplier part of the financial operation thing, but you can make something that's a little bit more elegant for a supplier to enter into that feels like the terms aren't cutthroat. What does that world look like, and how do we build it? That's the climate park exhibit. Come on, park play.
I want to double back on the topic on risk, and Nick and Britt's risk because it was also then shared. So we're gonna pick on. I know we're keeper who on it. Sweet. So when a lender sees a project a high interest market like Brazil versus EU, do they see a technical risk, or is it just lack of data? How does RTO help standardize the risk profile?
So one thing that when we first launched RTO, one thing we never wanted to do was just pile on the interest onto developers. Insurance isn't meant to be something that you're, selling your house to pay for. It's meant to be a security, a collateral if things go wrong. It's also not meant to be a first loss. It's meant to be something when things go really wrong, you go for insurance. You don't claim mobile insurance if you get scratched, right? If you lose your phone, you claim mobile insurance. So when it comes to the risk profile, I think when the lender comes to us, it's usually they are like slices of risk. So you would look at technology risk, political risk, execution risk, all these different 7 or 8 pillars of risk. And one thing that you don't understand, from a lender's point of view, they're not carbon specialists. So there's an uncertainty in all the above. And then everything is loaded onto that uncertainty. So political risk is classical, like I think Bolivia, I think you operate in markets where people think that there's a high political risk. So they would load everything onto that. Even if the science is perfect, you would still get a pretty high interest rate because in political risk, that's where the loading factor really is. So as specialists in this field, I don't think there's any specialist carbon lenders. They have carbon teams that are 1 or 2 people who are fighting the battle in their own companies. So as specialist carbon insurers, what we have to do then say, actually, let's try and understand the risk a little more than you do. And then we try and provide more context, more guidance so that they can pass their ICs. We still kind of struggle with that because I think you're trying not to give away too much of your own secret sauce, wherever that might be. But at the same time, you're trying to say, hey, if you say this to your IC, you might pass. So the way that normally it works currently is before lenders would offer terms to a developer, they would come to us and they would say, I'm about to go and finance this project, what would you charge me? So traditionally, the lender would say that I want to charge them 10% interest. I was saying this somewhere earlier, I think. So normally that's made up of your risk-free rate and then their margin. They can do multiple players in the middle, but that's the simplification. So you've not like a 4% lending rate and then the 6% margin. Insurance company would then come in and say, based on our risk assessments, I want to charge you 70% of your margin because I'm holding the risk. And then we would say, okay, we will charge you on 3.5% out of your 6% or 4%, 4 retail and 4%. And then so that's how the transaction works. Then they'll go to the developer and say, I'm happy to do this for you. Okay. This is such a simplification. I'm sorry. That's how it traditionally works. The one issue with this whole process, though, is that the insurance company that ends up holding all the risk. It's actually not the developer, the buyer, market phase, right? Service provider is actually the insurance company. So what you really need to do is have a portfolio of this. You want to have enough projects in your book that if there is a loss, you can pay that loss. We currently don't have that in the carbon markets. We don't have hundreds of projects that you can make a portfolio. So that's something we struggle with. Another way we help lenders that we've realized we need to do more of is not just lenders, actually, it's also pre-purchases and off-takers. They say we've invested all this money, how do we manage this asset? So we actually had a workshop recently with a bank, and they were using this GIS tool, and I look at it, I was like, we were using this 5 years ago. Like, you need to update your systems.
As soon as you said GIS, and I was like, is that a rounds tip? Like,
Oh, their system or so out because they have like a couple of people working on this, like I said, and they're fighting their own internal battles. So one way we say this, we have our underwriting model. We assess risk. Why don't we provide that to you for free of service? If you were to insure with us, we'll give you the whole thing for free. So that way they can actually manage their assets in near real time. That's one way we help the lenders be comfortable with, even if after they invest, they can manage their assets with us. And if there is a fire about to happen, if there's a drought about to happen, we'll let you know. You can do X, Y, Z. If a project's gonna fail, we will let you know because you're about to have a claim, we're about to have a claim. So time to get ready, time to get the wheels going. But those are some of the ways we help lenders. But I think it's really important to realize that lenders are not carbon specialists. They're just people who have usually an interest in carbon, who maybe change jobs. They have a couple of people on their team, and they have a whole range of battles to fight internally to get this to the line. So we try and package insurance in a way where they can use that support to get over the line.
Very cool, very helpful. through Eric Bay's package is offtake. Daniel, XML was scaled as C, but most, not all, CUR companies do that. So beyond just having a buyer, what is the specific financial unlock for partnership that ultimates money from pilot to scale about?
Yes. So I think, in the question you have the trick of how this happened, because we never built a pilot. We had the conviction that this was going to work at scale. And the very first year of Exomat, we were already at an annual capacity of 60,000 tons, 60,000 credits. which again is not a pilot, it's 3 very large industrial reactors. And I do think that speed really allowed us, not to scale gradually, but to, move extremely fast from the very beginning. There are several characteristics of where we operate that allow us to have certainty that we're going to have, for instance, a feedstock to be able to turn into biochar into the future. So this is a very unique aspect that we built our advantage of, but we didn't have a buyer from the beginning. So it's not that we found an offtake agreement and then we made the decision to, the investment decision to go ahead. We believed in the market. We still do believe in the market. We're bullish on the carbon removal market into the future for the demand. And it is that conviction that really allowed us to, get into the point where we are right now. I would say that, of course, it's a very different condition from where we started, 60,000 annual capacity, to where we are right now. We are at 300,000 annual capacity right now, and moving towards a little bit more than 500,000 annual capacity if everything goes well, which we expect next year. So to get to that magnitude, that's where what we were talking before about development finance and all of this is absolutely essential, because again, the financing costs just pile on each other, and we wouldn't be able to do it at the interest rates that we were discussing before. So this is the key part of the scaling up now. We do have great offtake agreements, but not at the beginning. I think that this was the thing that we knew that we had special characteristics that we can build upon, and the investment team and the leadership team of Exomed just took a big risk to go ahead in this mentality of if they build it, they will come, and that's where we are. We have sold all of our credits up to now. We have a good pipeline of credits sold into the future, and that conviction it's what allows us to move ahead into our next scale of plans. We believe that speed is of the essence in this business. It's absolutely of the essence, and we have discussed in the past in the carbon removal ecosystem that the opportunity is clearly there, but if we don't act fast, then it's not going to be a policy relevant tool to fight climate change. It's just we're not going to get to the gigaton level where the world needs it. So speed is of the essence. We want to maximize our capacity now. But yeah, I would say that from the point of view where we are right now, this certainty of future revenue that an offtake agreement brings is, of course, fundamental. And especially when lenders, they do not just see the offtake agreement, but they actually stress test it with the worst possible scenarios, right? So it is under bad conditions that we have the conviction in the market that this market is going to move ahead, and it is that conviction that drives us.
Really, really couple think that, you skip to the stage that fully made a big gut, but it works. Switching to Helix, where enhanced rock weathering grows at a different scale, and what you think about our feedstock being our main asset, we're literally spreading this across thousands of hectares department. So how do you convince financiers that this is a bankable industrial process rather than just a side experiment?
Yeah, that's a good question. That's just, I think, to give a lot of, if it's standing in a pile of, in front of a pile of rock powder, is quite important to understand the amounts and also the size we're talking about. So normally, a standard truck can operate and transport from A to B around 25 tons of rock powder. So we spread around 10 to 20 tons on a hectare. So for 1 hectare, you need like little less than 1 truck. Currently, we have more than 10,000 hectares of farmland under management and scaling quite significantly which leads to currently leaving 100 trucks per day transporting rock from mines to farms. An incredible long queue if you imagine you stand in front of this. And obviously this is a lot of money, which is transported there from the mines to the farmland. But as soon as you apply it on the farmland, it's gone. You can try, but it's very hard to get it dead. So it doesn't work as a collateral at the end for any one who wants to buy it. Finance it instead, like compared to now biochar facility, which you definitely can, I guess, use as a collateral. So our main collateral is of course the offtake contract, which we need. I think it's great that all those insurances exist, and I think they give a lot of comfort to potential buyers. We as a company, we set up to hopefully not needing those insurances. So everything I think the insurance wants to know, how risky is it that this company is going to execute those 100 trucks per day, leading at the end to a certain amount of carbon removal? It's the same question we also have. So I think we have very high interests in general to get all data points. And at the end, we are not a truck and logistic companies, we are a data and tech company, which is trying to get as much information we can from the beginning to just understand what's going on, and then transforming this information, this data, into actions. And this was in the past quite successful, and this is also our path forward to convince potential lenders, certainly with also the help of insurance, that at the end the execution risk is completely minimized. I think broadly speaking, also if you look at the current market situations where a lot of the offtakes are now signed or soon to be signed, the question is about how much more is coming. I think also here the problem will be that many of those companies will not be able to deliver. So I think insurances are needed more than ever. And I think on the other side, there is now a secondary market which is getting created, which companies which are good in delivery credits and having a high predictability execution power also to deliver credits in the short term, like the next 3 to 5 years, can fill in this gap.
Cool. To follow up on that, if the asset is diffuse, like rock color, or in a complex jurisdiction, does insurance unlock cheaper debt, or does it just reprice the existing as where it's a real value to a developer?
So we fundamentally believe that it doesn't unlock cheaper debt because we've done it already.
It's an expert point.
We've actually also added about 2 or 3 banks. We've encouraged them to come to the market. They like it in a deal for the first time because of insurance. I think that's quite an important part. I think when we see these offtakes announced in the market, these offtakes don't pay money, right? So developer still needs money to somehow fund the project. They can use their equity financing, which is super expensive. And developers should be getting away directly like that if they can avoid it. What other finances do you have? I think you mentioned this or not earlier, but in project finance, debt facilities, all these facilities, they all need insurance to go through. A funny story, like a couple of weeks ago, we signed like a agreement with a broker who would send us deals, and they sent us 20 renewable energy deals on the same day. And they were like hundreds of millions. We were like, we don't cover renewable energy, right? Like, we don't need these. But like, that's the scale of how renewable energy works. Offtakes are signed, and they all just get insurance straight away. So it doesn't happen without insurance. And that's what car markets are going towards now. It just happens very slowly, like trickles through. So all these Microsofts, all these Googles that have announced offtakes, they all would have insurance when the project financing goes through. So I think it encourages capital to come in. Whether some people might try for it if they want because they have insurance, that's up to them. But usually that's not what happens. Usually they come to us before, and then they price it, and then they offer that, especially because they're passing on that risk. One bad point also is that a lot of lenders currently, they don't want to hold any risk, which is an issue. So they would say that I want 100% indemnity. 100% indemnity means if something goes wrong, the insurance company pays everything. You never really have that. You shouldn't have that. That's the misalignment of its incentives. So what we try and encourage is like everyone to share a bit of risk. The corporate, I actually think off-takers should also have a little bit of risk in that, because ultimately they're benefiting from all the upside. But that's a controversial. Don't repeat that. But I think that then the financiers should hold some of the risk, and then the insurance companies should hold the rest of that risk. So I think that's really what insurance allows. I don't think we're repricing this. I think we're allowing more capital to come in. It's very similar to how other markets work. But in terms of, I think developers getting access to financing, I think there's also a quite important distinction to make. Developers don't pay for insurance. Maybe indirectly they do because financiers pay that they charge more. But I think it's also on us to make sure that developers get to that point where they're bankable as like a community. It's because of that we some people here already work with us on that. But that's why we offer like a free insurability service to them. So they come to us, they say, hey, I'm going to go on my fundraising journey in about 6 months. Would you insure me? We say yes, we give them a letter, and they can actually take that to the bank. So the capital provider that I mentioned earlier, that for the first time they made an investment, happened through that. So they were the biochar developer. They came to us and they said, I'm going to start a new project. We assessed it. We said we would insure your project whenever you get money. About a year later, a bank came to us and said, hey, this guy is friendly, came to me asking for money. Have you seen this? And within 2 days, we gave them a full information. Is that we're up to do this? So I think it's our job to kind of make sure that developers get to that stage as part of a package where they can get that financing.
It's really easy. I know you're chomping on what it's.
Yeah, I think it's plus one to everything Glog you said. I think that risk is a hot potato, right? Like nobody really wants to take it, and you kind of keep shifting it around. And I think every mature capital provider to every immature one, nobody really wants to do it. I think insurance's job at the moment has never been to actually take on the underwriting risk. And that's the capital provider's job that you guys are doing at the moment, which is helping more capital come into the market. Over a period of time, still shift, and I think that's what we want to be. But the point of it all is that through all of these experiments, we're like, right? So we did a deal with an enhanced rock piping provider a couple of years ago, and that was the first time when a major bank basically decided we're going to come into the carbon removal market and we're going to come in and take the risk, but that will not be possible without the drugs at all. And I think that we're just in it doing all of these experiments, we're learning how to price risk. We're learning how to transfer science, the amount of rock powder that we're actually putting out, or the amount of biomass that we're actually converting into biochar, into numbers that make sense within a risk matrix, or then into price bands that look like interest rates. And that's the only piece.
Austin. So, Swarley and Zerba, they'll have a start. To reach $8 trillion market and just fund projects we want by one. So how do we think about scaling funding? Funding projects is probably at work, but what else are you seeing emerge as sheets?
Yeah, I think getting atypical stakeholders into the commodity structure is the best way, right? This isn't a climate problem, folks. I just open the door and let the commodity brokers come through and look at selling that asset, giving them a taste of that spread and that exposure risk as a normal thing that they would include is a very important conversation to continue to have. So if you're not talking to those people, like Stonex, Trafigura, like all those, please have those conversations, because corporate's not coming to save us in any way, shape, or form. Even at NASDAQ, when we would buy things on the open market space, like Puro corks were less than 10% of our portfolio, and we had an outright mandate to stand that up, right? As the exchange, the minimum standard of care of a registry that a stock exchange, the fiduciary element would get behind. Like they were like 10% is good, no. The rest of it was nature-based solutions, and then staunchly in compliance market space were PPAs and NABIS, right? You frames the retrofit and the introduction. Knowing that energy build and continuing to work in it is important, because there's never not going to be money in the business of we need technologies, right? We live in the oil and gas supreme space. You see that price volatility going all over the place right now. Millionaires being made overnight. Will carbon removal get to that point of oil and gas volatility? I think so. That's what Wild Assets is built off of. And I'm a believing diehard climate activist, like an entrepreneur inside out, like break it up and build the company better. But I'm also sadly now a capitalist, where I'm like, no, we let these structures work on the exchange and allow people to continue to buy and invest in these pieces, increase that scope of opportunity where people just see it as a new commodity to get involved with. That's exciting to me. And I want that price volatility for suppliers, because over-the-counter trading sucks. High-velocity trading is excellent. you get to that price parity where people are trying to, they know they trust a particular type of project because it's reaching that scale size. But for us, that maturity curve is at a tipping point. There's not going to be a lot of price spreads that you'll get now. Biochar is consistent, right? Nobody necessarily wants to invest in biochar unless you're a private equity company looking to do a roll-up. But enhanced rock weathering, BECS, some direct air capture, marine CBR solutions, there's still enough uncertainty of how that should be priced in an open market, and that is and should be excited for suppliers. So argue your contract well. $1 billion, yeah, go for it.
Sorry.
Question. And on the traders point, we're seeing this with Corsair already.
Yeah.
And so traders is all run by Corsair. It's like Corsair's run by traders.
I believe you, I know.
All of it. That would be very bad.
Yes.
So traders are financing these projects. They're selling into airlines, and even with jurisdictional revenue to see, it's just traders really. They're all funding these projects. So why do you think it is that they're not involved in the renewables market? Even though like we are seeing policy like CRCS and all these ones come up,
Yeah.
and in a couple of years, hopefully, like you can beat into these markets.
It's a climate thing. I don't. That's I'm gonna say like the exposure that they'll see, and I spent some time working with LNG traders in Texas. The same thing. Like you kind of like put up your price potentials of like either methane combustion or refrigerants that are price pennies on the dollar. That's what they see, and then they're trying to compare it against a new and emerging asset class that's like, and then you had a project out of Brazil, and they're like, oh, that's really expensive compared to like the tonnage that we can purchase from these types of things. And I know I can move that. This is what the client wants, and they make a split decision, and that's it. So the exposure that you can continue to develop those distribution networks, I think, is very important because you're also co-educating, right? And this is the sad arbitrage that all suppliers have to wear is that you're a constant educator about why your product is helpful and noble. And that will never change. That is probably how we get to this $1 billion unlock. And even I worked with Tito and air miners, get them listed on the NASDAQ exchange just as a way of being, if you want a carbon renewable academy, like this is best in class. So it's like that distribution note of education is important. The signal, of course, always is that brand allocation, but until it's like in the hands of people who move molecules faster, it won't reach that.
But also, it's a little bit of worry is that right, like 90% of this long is forward.
Yeah, don't have enough. It's not there. Exactly.
Yeah.
And they can't turn it into something.
Yeah, exactly. And so liquidity and the atoms that you want to move need to move at pace. And so even if there's a lot of money chasing a few
High velocity trades.
yeah, that's cut. Yeah. Sorry, that was what. I definitely for a second forgot that.
I know the US busting its material.
Yeah. I think that this, even as I sat over here, I remember sort of listening very intently to everybody talk about their viewpoints, and I'm imagining everybody else sitting in the audience right now going, there are so many technical words over here that are being used that I don't necessarily know what is relevant to me. If you're feeling that way, then great. I empathize with you. If you're not feeling that way, then I think that's awesome. The headline that comes to mind is, it's going to be bloody hard to actually get things off the ground before compliance kick in. Let's just face it, fires are pausing to see where the noise settles. There are immense amount of activity there's immense amount of activities that is coming out of creative people, and Sarah and Wild Dust and all the work that you guys are doing is amazing, but EU demand signals be sparse, and all of us in this room are going to go after it, and that's amazing. But then how do we make sure that this actually gets to a $1 trillion market? We use the tools that we have in our hands, right? We use the offtakes that have been signed. We start to think about unlocking capital off the back of that. We start to translate that risk enough so that we all understand it, so that we can actually match the right pots of capital that I just listed down into the right kind of projects, right? Every capital provider that I work with has a different mandate. They come to me and they say, oh, I want to invest in X year, or I want to invest in, X, Y check, or I'm only really wanting to take Z amount of risk. How do you navigate that as a project developer? It's bloody hard. So you lean on experts in the field to be able to do that. A big part of our job at CUR8 is to be able to kind of match the right amount of capital to the right projects and then structure things in a way that makes sense. You don't understand miscon pricing? Sure, give it to us. We'll do it for you. The piece of work that my team and I have been working on over the last couple of months is to make sure that a lot of the lessons we've learned in transacting carbon credits with the British Airways or Mercedes F1 is translated into how quickly we can generate capital for you. So today we launched a tool that enables you to basically get an opinion on if you've got an offtake, how quickly and how much money can you unlock off the back of it. We'll give you the answer in minutes. If you work with us to do your diligence, we'll have a term sheet ready for you in a month with a bunch of banks that we're working with, who we can call, understand their appetite, and come up with heads of terms that we have got experience in crafting. And then once that's done, he can effectively start to work together with you to get you a loan crafted in 4 to 6 months. That ensures survivability, right? And until the market taps open up, it's very, very important that we continue to build and the entity to have the ability to move those molecules and move those atoms. Because without that, it's going to be really hard for us to actually dream of $1 trillion industry and not actually get there. So I think that's kind of the message that I put out. If you've got the tools, use them, be creative, lean on the experts, and we'll get this done.
Yeah, I mean, you're getting rid of information asymmetry. It's like we always do the same thing. It's like we send out a volume piece that we see in market, and we give that all the way out to like distributors and other people that we work with, and just say, hey, this is what we're seeing in market. This is what's available. It's like, please make sure that you consider this in your purchase like opportunities. But being able to offer those pieces, it's just something that didn't exist even a year ago, and that's like the rate of this space. So like it does get to I hope it gets to $1 trillion market. I'll buy you all boats. I think like that last piece is that we probably all remember that renewable energy credits weren't a thing in 2010. That market had to be stood up, and HSBC took a big leap of faith standing those markets up in China. And that became kind of like gold standard for how you can build in an emerging market space, get a bank to take a risk on all of the pieces, whether it's insurance, whether it's financing, and a geography that wasn't a primo space. And now that's all it's included in portfolios for corporate trading us back and forth. That wasn't that long ago, 10 years, but we don't, as you said, speed and scale, we don't really have that amount of time to wait for the market to mature. So.
Okay, so before we wrap up, one sentence contribute on what is the single biggest barrier to project bankable 326?
Well, with that first. It's good point.
This court.
I think we just need to find ways to finance smaller projects. I think you can't just have $20 million projects, $100 million projects. That's just not going to work, I think. For insurance, it can't work. I think you have to have small projects. So we try to do it. Lenders won't really do it at the moment. I don't think they'll look at anything that's like 1 or 2 millions. So I think the biggest barrier is actually being able to either aggregate them or financing smaller projects. We might actually do 2 policies that are under a minimum premium. So we're open to doing small projects. We just need a lot more of them instead of everyone having to go for the big offtake. Sorry, that's a lot.
No, you're good. No, I'm just like, I might want to follow you and be like, oh no, that was good. How do I say the one? My favorite way of meeting Matan was this quote. It's easier to get a venture capital check than it is to get an offtake. I want that concept to change. I want that concept of moving molecules, like to switch from oil and gas, like darlings of the world, over to us. I want to reclaim that. So that is what I'll end on. Move those molecules, and yeah, like,
They'll call us.
yeah. Hey, I only heckled you a little. Good luck.
Thank you. I would say that the biggest limitation of bankability is not having visibility on revenues into the future stress test. So if you don't have that, it's going to be very difficult for your project to be bankable. I'll stop there. What's helpful?
It had way longer than how to think. I'm not sure that a better answer. I think in general, what we experience as a barrier, especially for bankability and then for scaling now financing, is definitely the confidence in the market. And this is, I guess, for new financing entering the market, if it's that market instead of equity, for example. But I think this is also something which we believe we need to do more now, driving efficiency by more collaboration. And I think the overall market might be limited, the appliance market might take some long, no one knows. But I think there's an existing market. And if you look at the existing market, what holds buyers back or what leads also to pauses is not having enough credibility at the end to continue because many companies might fail. And I think this is the same problem many of the debt lenders facing at the moment. And I think focusing on collaboration and driving efficiencies of collaboration, I think is very important. Sorry, it was way more than one sentence.
Daniel's big so far another sentence.
My single word would be speed. I think that a lot of solutions and barriers we thought were true 3 years ago, which is, oh my God, we don't have a look through to the buyer. Oh my God, we don't have enough insurance. We don't know how to structure offtake agreements in a way that makes sense sneakily. We have the answers to now. We sneaky faster so that when the projects need the money, it's available to go. And so the way that we're doing that at CUR8 at least is to scan through a lot of human brains and prototyping that. So a lot of the work that our scientists would do is now available on our platform that can help us move faster. A lot of the work that I would do together with my legal teams is now available on our platform for us to be faster again. So at the very least, you're not sat on the other end deliberating. Is my project bankable? Have an answer now. And if it's not yet, you can effectively go, all right, what is preventing me from doing it now? And how do I get to that bankability stage? So I think, yeah, to sum it up, speed.
Let's know if you want people will be willing to move on that bankability piece before they're working.
All right, now we'll open up to questions from the audience. So Elise,
State your name and for directing your question too.
Hi, I'm Neil with Mass Reforestation. Thanks everyone for speaking. Sarah Beth, it's for you. Really fascinated by what you guys are doing. It's a really cool pieces on it. This might be your secret sauce, but
Yeah.
can you say what you think it would be driving future volatility in the markets that you're kind of banking on? Obviously, it's not a perfect corollary to aspects like fiscal
I'm
commodity.
happy to offer a few. We love, of course, the moments, so we're putting a lot of things in our portfolio that mimic that. So I think a lot, if you can make sure your projects identify with your European trading system, it's going to be inordinately helpful for your price and volume and longevity over the course of its existence. At that same time, that's the type of political driver we look for, so you can consider that the European market space is not really an emerging economy. Think about what that looks like from a LatAm perspective. Brazil is a very bullish space to be operating in, and we like seeing. We purchased a couple contracts out of Brazil, and we've churned on that already, which is exciting. Actually, through Terraset.
Wow.
But I think then that's where the supply, the demand meet is always going to be that interesting cross section, right? So if you can also help hedge your supplying your product as you're offering that back out, think like a trader in that way, protect your product, even from people like Baton and I. Oh, nice, I swear. But like that's what I would say. Those policy drivers everybody's looking at in a similar way, they're popping up in other areas. We probably won't really go into the UAE and Saudi thinking about it. So cool, great. Yeah.
Hi, my name is Quentin. I'm with Alithic. First of all, thanks everyone for your contribution and also for doing what you do. I think it's very important. I have a question to you regarding the overall demand for carbon credits. Where do you see the demand coming from? Is it going to, is there a pause at the moment in the market and people are in a wait and see mode, and to your point, Felix, they're going to reduce costs to keep it more efficient, make the asset, as if you call it this way, more attractive? Or is it to come from policy, or like where do you see the next work come from?
I mean, I get like a first thought here. Like, I think will not answer directly the question, but I think what's really important is that to not going in a path of a circle which is starting to go downwards, because everyone is talking about a pause, everyone is talking about the market slowing down, and if carbon removal suppliers and the whole market is also not to reduce and just completely switching into a survival mode, this will not give new buyers, existing buyers, the confidence they need to increase their purchases. So I think there's a lot of optimism still allowed. I think to switch from one to the other, this can happen very, very fast. So I think there's a lot of demand, which is still an existing market, which can be unlocked by bringing credibility and also confidence from delivering now in this existing market. And then the other answer about new potential buyers.
I could jump in. I think a big part of demand, especially in new buyers that are entering into this market, is going to come in the forms that we haven't necessarily experienced or expected. So a lot of conversations that I had on Monday and then early part of yesterday was around spot credits. So buyers that are, nervous about committing longer term, either because of, political reasons or capital reasons, want to still act on their kind of pledges, but they want to dip their toe into something that is more accessible. So spot is a great way of thinking about it. The other, and a really cool way of thinking about it is just a portfolio approach. So a lot of the buyers who actually have made, commitments to carbon removal, to Felix, you'll find, is they're very smart buyers. They're very, very mature in their corporate responsibility and net zero strategies. And so, they have put out a portfolio approach in the next couple of decades to figure out how to actually get to net zero. And so it's going to be on us to kind of find that initial hook and basically help them get to that space. That might look like short duration carbon removal, and then kind of transitioning into more durable carbon removal and at volumes when we need it. But having that approach in that, most people, sure, there's a pause because that's also, as a result of macroeconomic shocks that everybody else is feeling too, doesn't mean that people are going to stop looking at carbon removal. We're going to need it eventually. The world is getting hotter, and in the next 4 years, we'll have tipped over a lot of our, emergency points. So doing that, and then the only other thought that I would offer is, not a lot of carbon removal pathways will have that, but the opportunity to integrate it with an existing infrastructure is huge. If carbon removal was to go in and become invisible just as a service, so good examples are, bikers companies or weathering companies that are, working within the wastewater treatment space by shell companies that are taking crop residue and turning it into something useful and fertilizer. That is a really good way to make carbon removal effective as something else that people are willing to go for as well.
It's a really good point. It's if you look at any of the registries, especially Puro, spot credits do not sit on that registry for longer than a month. It's just, they're gone. So it's this, I really believe in this idea of you have the tools in your hands to become the masters of your own universe by waiting a little bit longer to realize that spot moment year on year. But obviously the whole point is if you can't create the carbon, then you have to extract the water. But there is a very real proof of purchase point that's been consistently delegated for the past few years, and you probably could speak more about that. But that doesn't sit at Rogues.
And that is the stage of the current market, but I do want to take a more existentialist approach, as you were saying. And it really has to do with what you said at the end. IPCC, Intergovernmental Panel on Climate Change, saying it is unavoidable to have permanent removals in order to reach our temperature goals. Unavoidable. The Paris Agreement is a net zero agreement. It involves removals. And I do think that the question in the end is not whether there is going to be demand or whether we're going to have climate breakdown of society. It is essential to have these tools in order for us to achieve our temperature goals. So we need to achieve them on a time frame. We don't have until, we don't have to do long. So it is on this very core first principle idea that we believe that demand will come from unexpected places. Demand will come it might come from democratic pressure. It might come from really unexpected places because of the consequences of climate change. So are we going to just trying to survive just for the next few years, and then when we're going to need the removals at scale, we're not going to have them? I don't think that's the right approach. I think that we should push for demand as fast as possible. We are in a climate emergency and we don't have time to waste.
I have a slight different point to add. So I think we have a tendency to look at Western markets. I think Asian markets are advancing towards compliance. China has a 5% permission to use offsets for their target. China is the biggest emitter. Like that's the 3-4 billion annual kind of investment that's needed to meet that. And in most cases, China, I think they will be using those offsets because the price is lower. Now there's a quality issue generally, but that market is still there. We have the ACCU market. We have Indian market that is starting their compliance systems.
This year.
Yeah, exactly. We have the GICTS. We have all these markets. I think we tend to just focus on the US and Europe. So these are all markets that are available. And then lastly, I think quite important, and it's quite sexy, I think, which is CBAM. I think the person asked the question, you make low carbon cement. Yeah. CBAM is like a perfect example of that. You will be, I think you will be able to use that in those supplying markets as a deduction. If you can make those carbon credits or lower emission factor, you will be able to utilize that revenue at CBAM. Now, CBAM is going away. So I think demand does exist. It just exists in other markets. So it's time to kind of reach out to them.
Well, very much for my mass. Yeah, it's a global perspective. My design system, Bay Area, but there'll be a time for maybe one more question. Yep.
And takers, no? All right. But we'll wrap up. I want to thank our panel
Be here today, sharing such relevant, brilliant insights, and injecting a little bit of optimism into the conversation, which is important to carry us forward through the rest of the week and the rest of the year. I also want to share that in collaboration with CUR8, we are going to be publishing a report on financing carbon removal. And thank you to everyone for being here today. We will be sending you and the preview of the report.